All right, welcome back. So today we're going to cover the newly published article on our website. And this article forms as the basis of the previous article that we published regarding buy-sell agreements and succession plans. And for what we do is we put this on screen and I'll read it right through with us so I can provide sort of some of my insights. Connelly versus the United States in the IRS. So here's what happened and why it's important. We'll cover Connelly versus the U.S. and my sort of interpretation of the ruling. The decision has been made. You can click and view and download the actual official decision here on the website. But this court case is now going to form the foundation for how buy-sell agreements are written in the future. I can't state how important this is to business owners, especially in closely held businesses. So in summary, on June 6, 2024, the Supreme Court of the U.S. unanimously ruled in favor of the IRS regarding life insurance proceeds paid via an entity purchase agreement. The decision came 11 years following the passing of Michael Connelly, the majority shareholder of Crown C Supply. I think this is in Missouri, St. Louis area. So what should you be asking? What happened? Where did they go wrong? That is Connelly's. Was the decision fair? And we'll discuss that. And why do I need to help business owners avoid this happening to them? And yes, you can. And mention here, this is the opportunity for life insurance advisors because you should be on the hunt. If you have existing business clients who already have buy-sell agreements in place, they're going to likely need revisions, at least a review. And you should be out looking for others, new people who have not yet put in place a buy-sell agreement, because these are even all the more important now going forward. So what happened? And listed some facts and events that occurred leading up to the case. Michael Connelly, he was the brother. He was the majority shareholder. He owned 77.18% of the company's shares. The brother, Thomas Connelly, the minority owner, owning 22.82% of the shares. And this is going to become very important, is this previous original evaluation at $3.89 million. It's part of the dispute. So within the succession plan was an entity purchase agreement funded with a $3.5 million life insurance policy, one on each of the brothers. So each brother had a policy on the other. And notated here, in an entity purchase agreement, the corporation is the owner of the policy. Now, we won't go into the differences between each type of insurance policy used in buy-sell agreements yet. We'll cover that in a little while. But understand that the entity purchase agreement, the corporation is listed as the owner on the policy. It's very important to understand now. The succession plan stated that in the event of one of the brothers' death, the other brother would have the option to purchase the decedent's estate. If the option was not taken, the company would be obligated to use the life insurance proceeds to purchase the decedent's estate. So it's very typical to see this. The surviving owner has the option, not the obligation, to purchase the shares directly. If he chooses not to do so, the obligation lies therein with the corporation to make the purchase. And in this case, with an entity purchase agreement, the proceeds are already being paid to the corporation. So it's an easy transaction to make, or at least in the past it was. Michael passed away in 2013, which gives you a timeline here that basically 11 years go by before this decision is finally made. The surviving brother elected not to purchase directly, so the corporation exercised its obligation to purchase the shares from the decedent's estate. The agreed upon purchase price was $3 million, and this is also very important in this case. Do the simple math of 77.18% of $3.89 million, it does come out to nearly a dead even $3 million. So I agree with the purchase price calculation. You'll come soon to find out that the IRS did not agree with that. So the corporation used $3 million from the life insurance proceeds to purchase the 77.18% shares. The remaining $500,000 was put into the operating account of the business. Very common practice. Use the proceeds, purchase out, any leftover stays with the business. In an entity purchase agreement, that's how this would work. So the Connelly estate filed an estate tax return showing a value of $3 million for the estate sold. So there's the timeline of events prior to anything getting heated. But as this next portion of the article is going to point out, we're going to run into some little heat here. So filing the estate tax return with the IRS. As the IRS agent reviewed the filing, the agent flagged the return for audit. The basis for the flagging was that the $3 million purchase included no independent appraisal on the value of the shares. With such a large transaction, the IRS wanted to confirm that the buyout was executed according to the succession plan, including an accurate valuation of shares sold. That doesn't surprise me. The $3 million purchase, and there's a transaction showing this purchase, and there's nothing backing, no receipt backing the transaction. So it doesn't all surprise me that this got flagged. But if you look at the statistics, less than 2% typically get audited. The life insurance policies historically have not been required to be included in the valuation. When a buy-sell agreement is funded by an entity purchase agreement, the corporation is the owner of the policy. However, the Connelly's $3.8 million valuation did not reflect any future life insurance proceeds. And like I stated before, this is very common. It's not required that the proceeds are included in the valuation. Even though the life insurance policy is listed in the corporation's asset column, it is offset as a liability for the corporation's obligation to purchase the decedent's shares. If you look at your balance sheet, the corporation will have in its assets column the value of the life insurance policy itself, and the amount for the purchase of the shares of the deceased will show the amount paid. But this is an offset, so the asset and the liability should cancel each other out, and historically that's the way it would be. So the IRS disputed the $3 million value of the purchased shares reported, claiming that the company's valuation for estate tax purposes should have included the value of the insurance proceeds used to purchase the shares. And here's my stance on that is if you look back into the history of these type cases, the IRS has been quite active in pursuing cases like this when it comes to business sellouts. But the Blount case, I think it was brought up in 2004. It was the U.S. tax courts who ruled in favor of Blount. And what's very contradictory here is that in the Blount case, the court found that if a buy-sell agreement obligated a company to use the life insurance to redeem shares from the estate, then that portion could be excluded from the company valuation. So we have a direct conflict. In this case, it was 2004. I think it was run through the U.S. Court of Appeals, I think of the 11th Circuit in 2006, and the Court of Appeals upheld the original 2004 decision. So the fact that this happened then, and the result was this, and now we have this new decision, and it's seeming like it's going against it. I don't like the contradictory. There's no inconsistency here, and it seems like the Blount case should have set precedent for the Connelly case here, but we'll read on. You'll learn what happened. So in the eyes of the IRS, the company valuation for estate tax purposes was $6.8 million. So they simply added, among other things, the value of the life insurance proceeds. The value of the decedent's 77.18% stake was much larger than the $3 million that was reported. And if you're doing the math, that's now valued at $5.29 million. Interesting to note, the life insurance policy was $3.5 million. So in this case, the life insurance proceeds was not even enough to purchase the intended estate. This was an impact when it comes to the estate tax owed to the IRS by the Connelly estate. It would added an additional $889,000, basically $890,000 additional tax liability placed onto the Connelly estate. So let's talk about what went wrong, what the Connellys failed to do. So the Connelly estate appealed the IRS's decision. Their basis included two primary arguments. Number one, the entity purchase agreement stated a fixed value of the shares for estate purposes, which basically is the agreed purchase price. And typically there's nothing wrong with this if you have the appraisal attached. Number two, the obligation for the corporation to purchase the shares created the offsetting liability we talked about earlier, thereby canceling the purchase amount from the asset column. So these are the two main arguments going into the court case, and the lower courts rejected both arguments. The first argument was easily disputed as there existed a failure on the part of the Connelly case. They left this out, basically. The courts ruled that the entity purchase agreement could not be used to preset the value of a company's shares for estate tax purposes. The agreement clearly stated that, and this is true, in the event of a buyout, and this is inside the original purchase agreement, was that there was to be two documents included. It was an either or type thing. So if it had this in place, it would have been fine. The purchase price determined by what's called a certificate of agreed value. This likely would have been just a simple appraisal, and it's assessed year over year and be inserted into the buy-sell agreement with the company's documents. As the buy-sell agreement stated, if this was not in place, it was to submit two third-party appraisals of the business upon the buyout. So neither of these was submitted with the estate tax return. It's likely speculated that the Connellys, they were brothers. This was family business, and once they made kind of a pre-assumption that they were going to do the purchase at $3 million, I think they fell behind on keeping this up, and turns out it ends up burning them on the case. So let's talk about the second argument. However, the second argument was the main event for the fight, and this is important for each case going forward upon this argument. So the implications around this argument would affect many, many business owners immediately and would set the foundation for all future successing plans. The courts ruled that, again, for estate tax purposes, a corporation's obligation to purchase a deceased owner's stake pursuant to a buy-sell agreement does not offset the value of life insurance proceeds paid to the corporation. Again, this is in direct contrary to the Blunt case of 2004 and 2006. So, again, I'm unhappy with the inconsistencies. This case made it all the way through the courts of appeals and to the Supreme Court of the United States. Each court upheld the lower court's decision, so it made it all the way through. And the fact that this was a unanimous decision by the Supreme Court, take that as you want. But so what is the basis for their decision? Some of this I agree with, some of it I don't. But much speculation has spurted from the IRS's new avenue of obtaining even more state tax from successful business owners, even at their death. But pushing the speculation aside, here's the explanation provided in a hypothetical. And this is kind of what the IRS used in their presenting to the courts. In the Connelly case, the buy-sell agreement was written for the intended purchase made by the other family member. So what if a third-party buyer was allowed to enter into the bidding? The third-party buyer may even be willing to pay for the shares based on the full valuation of the business, which includes the insurance proceeds. So basically, they're saying that if a third buyer were to come in, then this buyer would be forced or obligated to purchase at the full valuation, which includes the insurance proceeds. And this would be a much higher purchase price, thereby being a higher estate tax filing. Here's the U.S. Revenue Code section regarding these types of agreements. If you look it up, you can click here and get to it directly, but it's the U.S. Code, Title 26, Subtitle B, Chapter 14, Section 2703, Subsection B, Line 3. It's talking about the agreements. Terms are comparable to similar agreements entered into by persons in an arm's length transaction. What this means is these agreements cannot be written without the consideration of this third party potential buyer who is willing to pay full price. So family deals would ensure that the IRS would miss out on the opportunity to collect the higher estate tax revenue. So what are the takeaways here? What can we do? What should we take from this, and how should we move going forward? Obviously, every business owner must create a succession plan, even if you are sole owner and even if you are planning to sell your company before death. If you go back to our previous article, we talk about this as well. We make the joke of the business partner's wife becomes the new business partner of the surviving partner. Why? Because if they don't have the cash to purchase out that estate, that you have a new business partner on hand. So if you already have buy-sell agreements in place, you should have them reviewed by your life insurance advisor. Like the Connelly case, your entity purchase agreement won't provide enough funds to purchase the intended estate, leaving a mess of unsold shares in your family's estate. Again, in the Connelly case, the new valuation is 5.29. The original was 3 for just that 77%. So yeah, the insurance, even using the $3.5 million, was not enough to purchase the full estate. Now it has to be worked out how to handle the rest of the buyout between the surviving owner and the deceased estate. I don't even know the result of that, honestly. So your estate tax liability may be drastically higher than you've anticipated. Like in the Conleys, they owed an additional $890,000 due to this case. The value of your business may have increased, making your existing buy-sell agreements insufficient. The increasing revenues of the business, which is increasing the valuation of the company, should then bring upon a review so that you get your life insurances updated so that the buyouts reflect the percentages that will be bought out in a succession. And finally, not only will you need the right buy-sell mechanism, you should also learn the best life insurance vehicles that provide adaptability while maintaining tax-deferred growth and access to the policy's cash values. So the means by which you set up a buy-sell agreement and the vehicles that are best for that, considering to the business's long or short-term goals, certain policies will provide better vehicles than others, but in this case, the IUL is very adaptable, and if the business takes a direction where it no longer wants to sell early, it decides it wants to take on growth, it has a cash value that's there as a reserve, which will give it cash flow to push off this expansion. A lot of things we'll talk about in a consultation and look at your business goals. But real quick, I want to go over the 4 means and why this entity purchase agreement was important to cover here. It is the most widely used because it is the simplest to set up, to structure. In a buy-sell agreement with 2 or 3 even owners, the entity purchase agreement is actually simplest to set up. There's just a single policy per shareholder. In the Connelly case, however, a cross-purchase agreement would have been an entirely different experience for them. This case likely never would have even occurred because of the behavior of the cross-purchase policy is that the beneficiaries are direct to the estate. It doesn't flow through the companies. The third way is the cross-endorsement agreement. We'll talk about that in another video as well. And a fourth way to do it is through what's called a special purpose insurance LLC or a trust will operate the same way. But those are the 4 different ways. Again, it's the cross purchase agreement, the entity purchase agreement, the cross endorsement agreement, and the special purpose LLC. I would get to know all 4 of these quite well. So I hope this video adds some useful context to the article, and we'll see you on the next video.